In this video, I'm going to discuss about functional budgets. Functional budgets are budgets that are prepared for specific functions or activities within an organization. These budgets are used to plan, coordinate, and control the activities of the different functional departments within an organization, such as sales, production, marketing, research, and development. Functional budgets typically include detailed projections of the revenues and expenses associated with each function or activity. These are the most common functional budgets within an organization: sales budget, production budget, cost of goods sold budget, direct material usage budget, direct material purchases budget, direct labor budget, production overhead budget, cash budget, budgeted statement of profit and loss. This is also known as the income statement. Budgeted statement of financial position. This is also known as the balance sheet. There can be other functional budgets as well. You can identify these statements. These are the profit and loss statements. This is for marginal costing, and this is the statement of profit and loss for absorption costing. All of these elements are functional budgets in an organization. As we discussed earlier, we can find each of these functional budgets separately. After preparing these functional budgets, we can budget the net profit for the next year. And so this statement will be the budgeted profit and loss statement. Depending on the costing technique which uses by the company, we can prepare the budgeted profit and loss account for marginal costing or absorption costing. Now let's discuss about the master budget. A master budget is a budget that summarizes all of the functional budgets of an organization into a single comprehensive plan. This means all of these functional budgets will be summarized in the master budget. As now we know, each of these functional budgets will summarize the net profit for the next period. This is the budgeted net profit. So all of these budgets will be summarized into the income statement. So what will happen? The cash budget and the budgeted statement of profit and loss and the budgeted statement of financial position will be included in the master budget. This is important to notice that master budget will only consist of the cash budget and the budgeted statement and profit or loss and the budgeted statement of financial position. Master budget comprises of budgeted income statement, budgeted balance sheet and cash budget only. This is really important. The master budget typically includes a range of budgets such as the sales budget, production budget, cash budget and the capital expenditure budget. You may think how the master budget comprises only these three statements, but on the other hand, it states that it includes a range of budgets, including sales, production, cash budget, and capital expenditure budget. This is because the budgeted statement of profit and loss will include all the functional budgets summaries. These budgets are interrelated and are used to estimate the organization's revenues, expenses, and cash flows for the upcoming period. Identifying the principal budget factor is an essential step in the budgeting process because it allows managers to focus their attention on the most critical aspects of the organization's operation. This is really important. Principal budget factor. Let's discuss about this. Principal budget factor. It is the single factor that has the greatest impact on the organization's overall performance, such as sales volume, production capacity, or labor hours. These are the most common principal budget factors for an organization. But most commonly, we use the sales volume as the principal budget factor. Principal budget factor is the bottleneck of the company which limits production ability. Management accountants should identify the principal budget factor before starting the budgeting process. The principal budget factor is a critical element in the development of the master budget because it influences the level of activity for all of the other budgets within the organization. This means, in order to prepare the budgets, management accountants should identify the principal budget factor first. Based on that principal budget factor, all of the other budgets will be prepared. Now let's do this example so you can understand how the budgeting works. Company A manufactures product X and they use marginal costing. Management accountants of the company have identified that sales volume is the principal budget factor. So they have directly given us the principal budget factor, which is the sales volume. 2,500 units are expected to be sold in the next year, and the budgeted selling price per unit is $300. Budgeted marginal cost per unit is $9. The opening inventory and the closing inventory for the next year expected to be 450 and 620. Calculate the budgeted sales volume and the budgeted production units and the budgeted production cost for the next year. As we discussed earlier, they have given the principal budget factor. So first of all, we have to prepare the budget for the sales. You already know how to calculate the sales revenue. Sales revenue is equal to sales units multiplied by the selling price per unit. Now let's calculate the budgeted sales revenue, which is equal to budgeted sales units. They have given the budgeted sales units as 2,500 multiplied by the budgeted selling price per unit, which is equal to $300. This is equal to $750,000. This is the budgeted sales revenue for the next year. Let's go back to the statement of profit and loss. We just calculated the sales revenue, which is this value. So the functional budget of sales revenue is $750,000. Like that, now we can prepare all the functional budgets for the statement of profit and loss. And the second requirement, budgeted production units and budgeted production cost for the next year. You know this formula already. We discussed about this under marginal and absorption costing. So the production units is equal to sales units plus the closing inventory minus the opening inventory. If the question is giving you the increase or decrease in the inventory instead of the closing inventory amount and the opening inventory amount, you can use these equations. Sales units plus increase in inventory. If the question is giving you the increase in the inventory, you can use this formula. What is the meaning of increase in inventory? Which means that closing inventory is higher than the opening inventory. Decrease in inventory is where closing inventory is lower than the opening inventory. Then you can use this equation. Sales units minus the decrease in inventory. Now let's calculate the production units for this example. So the production units is equal to sales units, which is 2,500 plus closing inventory. Closing inventory is 620 minus the opening inventory. Opening inventory is 450. This is equal to 2,670 units. So this is the budgeted production units for the next year. Now let's calculate the budgeted production cost for the next year. So the budgeted production cost is equal to production units multiplied by the production cost per unit. So this is equal to 2670 multiplied by the 9, because they have given the marginal cost per unit as $9. So this is equal to $24,030. So these are the values that will be included in the production budget. The third requirement, prepare the cost of goods sold budget. We can use this equation to find the cost of goods sold. You know this equation already. Cost of goods sold is equal to sales units multiplied by the production cost per unit. Or you can use this equation as well. This will also give you the cost of goods sold. Opening inventory plus the production units minus closing inventory multiplied by the production cost per unit. So basically this segment of this equation calculates the sales units. So this value will be here. Now let's calculate the cost of goods sold using the first equation, which is equal to sales units, which is 2500 multiplied by the production cost per unit, which is $9. This is equal to $22,500. Now let's use the second equation, which is equal to opening inventory, which is 450 production units. Production units is equal to 2670 as calculated here, minus the closing inventory 620 multiplied by 9, which is also equal to $22,500. Both of these equations will give you the same answer. And now they have given extra information for the example question. Direct material C per unit 3 kilograms and 1 kilogram is equal to $1. Direct material F per unit is 4 kilograms, 1 kilogram is equal to $0.5. Now they are asking to calculate the budgeted material usage and budgeted material cost for both materials. We can use this equation to calculate the material usage. Material usage is the amount of materials which will be used in the production. So material usage is equal to production units multiplied by the material usage per unit. So material C usage is equal to production units, which is equal to 2670 multiplied by material usage per unit, which is equal to 3 kilograms. This is equal to 8010 kilograms. Now let's calculate the usage of material F. This is equal to production units 2670 multiplied by 4 kilograms. This is equal to 10,680 kilograms. So these are the material usage for the next year. Now let's calculate the budgeted material cost. So for material C, the cost is equal to 8010 kilograms multiplied by $1, because 1 kilogram of material C is equal to $1. So this is equal to $8010. The material cost for material F is equal to 10,680 kilograms multiplied by 0.5. This is equal to $5,340. So these are the budgeted material cost for the next year. And now they have given some extra information as well. These were given earlier and now they are stating that the expected normal loss for both materials are 3% each. What is the normal loss? Normal loss is management accountants are expecting this amount of loss in the next year, whereas abnormal loss is where management accountants are not expecting this loss. If they are expecting a loss, it is called the normal loss. If they are not expecting a loss, which is known as the abnormal loss. So in this example, they are expecting 3% normal loss for each material, which means in the production, 3% of the material will be a waste. So now we have to calculate the budgeted material usage for both materials. Earlier we calculated the material usage without loss, which is this. This is the material usage without loss. which means 100% of the material usage will be contribute to the production. There will be no wastage. But here they are expecting 3% of wastage, meaning 100 kilograms of material being used in the production, 3 kilograms will be a waste. The other 97 of the kilograms will be contributed to the production. So now what we have to do is we have to calculate the material usage with normal loss. So now what we have to do is we have to calculate the material usage with normal loss, which means management accountants are expecting this amount of loss. So this is equal to production units multiplied by the material usage per unit divided by 1 minus normal loss. Very important thing to note here, you have to convert the percentage value into a decimal value for the normal loss. Do not use the percentage value as it is. Now let's calculate the material usage with normal loss for material C. With loss is equal to production units 2670 multiplied by 3 kilograms divided by 1 minus normal loss. Normal loss is 3%. We have to convert this into a decimal value. So divided by 100. This is equal to 8257.73 kilograms. As now you can see, this amount is higher than the earlier amount, which is this. This is because now there will be a wastage. So the material usage will be increased with the loss. Very important thing to notice here, even though there is a normal loss, the company has to produce the number of production units they have budgeted for. In this case, it is 2670 units. So don't think since there is a normal loss, they are going to produce less. No, it is incorrect. They are still going to produce 2670 units, but the material usage will be increased because there will be a normal loss. Now let's calculate for the material F with lost. This is equal to 2670 multiplied by 4 kilograms divided by 1 minus 3 over 100. This is equal to 11,010.3 kilograms. This means the company is going to use this amount of material F and this amount of material C. 3% of each of these material usage will be a normal loss. So the other 97% will be contributed to the production. Now let's go to the next requirement. Now they are giving us the opening inventory for material C and material F. Do not get confused with the opening and closing inventory for the units and the material. Here they are giving us the opening inventories for material. We do not use these materials to calculate the sales units. This is only for the calculation of material purchase. And here they are saying us for both materials, closing inventory are expected to be 0, which means there will be no closing inventory for material C and material F at the end of the next year. Calculate the direct material purchases budget, which means this is the amount that the company has to purchase for the production for material. So we can use this equation to calculate the material purchases, which is equal to closing inventory of material minus the opening inventory of material plus the material usage. If the question is giving you that there is a normal loss, you have to use the material usage with loss. If there are no losses, you can use the material usage for the production without losses. So now let's calculate the material purchases for material C and material F when there is a normal loss. Let's say 3% normal loss. So we can use these material usages for material C and material F. So for material C, the material purchase with loss is equal to closing inventory of material. which is 0 minus opening inventory of material, which is 7,000 kilograms plus the material usage with loss, which is equal to 8,257. So the company has to buy 1,257.73 kilograms of material C for the next year. Now let's calculate the material purchases for material F. Material purchase with loss. This is equal to 0 minus 10,000 plus 11,010. So in the next year, the company has to buy 1010.3 kilograms of material F for the production. And they have given the direct labor hours per unit is 1 hour, and 1 hour will cost $2.5. So calculate the labor hour usage budget and labor cost budget. This is really simple. Labor hour usage is equal to production units multiplied by the labor hour per unit. So the company is going to produce 2670 units, and direct labor hour per unit is equal to 1 hour. So this is equal to 2670 hours. This is the budgeted labor hour usage for the next year. Using this value, we can calculate the labor cost budget, which is equal to 2670 multiplied by 2.5. This is equal to 6675. And finally, they have given the variable overhead per unit, which is $1.5. So calculate the variable overhead cost budget. So variable overhead is equal to production units multiplied by the variable overhead per unit. So the production units is 2670 multiplied by 1.5. This is equal to $4,005. These are the most common functional budgets within an organization. There can be other functional budgets as well. Now you know how to prepare functional budgets. Using these functional budgets, we can prepare the budgeted statement of profit and loss. Thank you for watching. See you in the next video.